Unfiltered Finance.
Top 10 long-term investments in July 2022. 1. Growth stocks. If you're considering buying individual growth stocks, you'll need to do a thorough analysis of the company, which can be time-consuming. And given the volatility of growth stocks, you'll want a high level of risk tolerance or a commitment to hold the stock for at least 3 to 5 years. 2. Stock funds. If you're not ready to put the time and effort into analyzing individual stocks, a stock fund, an ETF or mutual fund can be a great option. If you buy a diversified fund, like the S&P 500 Index Fund or the Nasdaq 100 Index Fund, you'll get plenty of high-growth stocks as well as many others. But you'll have a more diverse and secure set of businesses than just owning a few individual stocks. Equity funds are a great option for an investor who wants to be more active in using stocks but doesn't have the time or inclination to pursue investing as a full-time hobby. And by buying a stock fund, you get the weighted average returns of all the companies in the fund, so the fund is generally less volatile than if you held only a few shares. Promissory note: if oil prices rise, many stocks in the fund could suffer. 3. Bond funds. A bond fund, whether a mutual fund or an ETF, contains many bonds from many different issuers. Because a fund can hold hundreds of types of bonds across many different issuers, the fund diversifies its holdings and reduces the portfolio impact of any bonds that fail. Bonds are considered safe compared to stocks, but not all issuers are created equal. Government issuers, especially the federal government, are considered fairly safe, while corporate issuers' risk levels can range from slightly less to more risky. 4. Dividend stocks. Where growth stocks are the sports car of the stock world, dividend stocks are sedans. They can deliver strong returns, but aren't likely to rise as quickly as growth stocks. Many stocks offer dividends, but they are often found in companies that are older, more mature, and have less need for their cash. Dividend stocks are popular among older investors because they generate regular income, and the best stocks increase that dividend over time, so you can earn more than you would otherwise. Fixed payment of a bond. REITs are a popular form of dividend-paying stock. That said, if a dividend-paying company doesn't earn enough to pay the dividend, that company will reduce its payout, and its stock may fall as a result. 5. Value stocks. With the market rallied so much in the past 2 years, the valuations of many stocks have been stretched. When this happens, many investors turn to stock pricing as a way to be more defensive while still potentially earning attractive returns. Value stocks could be an attractive option in 2022, as they tend to perform well when interest rates rise, and the Federal Reserve has signaled a possible rate hike this year. Bonus: valuable stocks can grow faster than other valueless stocks if the market favors them again, increasing their valuation. 6. Target date funds. Target date funds are a great option if you don't want to manage your portfolio yourself. These funds become more conservative as you get older, so your portfolio will be safer when you're nearing retirement when you need the money. You choose your retirement year and the fund does the rest. Risk: target date funds have many of the same risks as equity funds or bond funds because they are really just a combination of the two. As the target term fund gradually shifts to more bonds over time, the fund will generally start to underperform the stock market in increasing numbers. You sacrifice return for safety, and since bonds don't pay off much these days, you're putting your money at greater risk. 7. Real estate. In many ways, real estate is the archetype of long-term investing. It takes a lot of money to get started, commissions are quite high, and profits often come from holding an asset for a long time and rarely just a few years. Real estate will remain the preferred long-term investment for Americans in 2021, according to Bankrate research. Real estate can be an attractive investment, in part because you can borrow money from a bank to finance it. Invest the majority and then pay back over time. That said, although real estate is often thought of as a passive investment, you may need to do some active management if you rent out the property. If you've picked a good asset and are managing it well, you can earn many times over your investment if you're willing to hold the asset over time. And if you pay off the mortgage on a property, you can enjoy greater stability in cash flow, which makes rental properties an attractive option for investors. 8. Small cap stocks. Small cap stocks are often also high growth stocks, but not always. Like high-growth stocks, small-cap stocks tend to be riskier. Small businesses are generally more at risk because they have fewer financial resources, less access to capital markets, and less power in their markets. But well-run companies can offer huge benefits to investors, especially if they can continue to grow and scale. Like growth stocks, investors will often pay dearly for the earnings of a small-cap stock, especially if the stock has the potential to grow or one day become a top company. And that high price tag for a company means that small-cap stocks can drop quickly during tough market times. If you are going to buy individual businesses, you need to be able to analyze them, which takes a lot of time and effort. Therefore, buying small businesses is not for everyone. As a result, small-cap companies are considered to have more business risk than medium and large-cap companies. 9. Robo-advisor portfolio. You will fill out a questionnaire at the start so that the robot advisor understands what you need from the service and then handles the whole process. The robot advisor will select funds, usually low-cost ETFs, and build you a portfolio. The management fee charged by the robot advisor, usually around 0.25% per year, plus the cost of funds in the account. Mutual funds charge a fee based on how much you've invested with them, but funds in a robot account typically cost around 0.06% to 0.15% or $6 to $15 per $10,000 invested. With Robo Advisor, you can set the account to be as aggressive or as conservative as you want. If you want a mostly cash account or a basic savings account, two of the top robot advisors, Wealthfront and Betterment, also offer this option. But best of all, a robot advisor can build you a diversified portfolio that can meet your long-term needs. If you buy a lot of equity funds because you have a high tolerance for risk, you can expect more volatility than if you bought bonds or kept cash in a savings account. 10. Roth IRA. The Roth IRA is possibly the best retirement account out there. It allows you to save money after taxes, grow your money tax-free for decades, and then withdraw it tax-free. Plus, you can pass that money on to your heirs without paying taxes, making it an attractive alternative to a traditional IRA. So if you have your account with one of the best Roth IRA brokers, you can invest in almost anything that suits your needs. This investment is just a CD inside the IRA. It's as safe an investment as there is, though you'll still have to hedge against inflation. Thanks for watching our YouTube channel. Don't forget to subscribe to reaching out top company stories and breaking news with unfiltered finance.